A mutual fund is a type of investment vehicle that pools money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other securities. Managed by professional fund managers, mutual funds aim to provide investors with capital appreciation and income. Types of mutual funds. 1. Equity funds. Invest primarily in stocks. Aim for long-term capital growth. Subcategories include large cap, mid-cap, small cap, and sector-specific funds. 2. Debt funds. Invest in fixed income securities like bonds and treasury bills. Focus on generating regular income with lower risk compared to equity funds. 3. Balanced or hybrid funds. Combine equities and fixed income securities. Aim to balance risk and return. 4. Index funds. Track a specific index like the S&P 500. Offer lower management fees due to passive management. 5. Money market funds. Invest in short-term, high-liquidity instruments. Aim to provide safety and liquidity with modest returns. 6. Sector funds. Focus on specific sectors like technology, healthcare, or finance. Offer higher risk and potential return based on sector performance. 7. International global funds. Invest in companies outside the investor's home country. Provide diversification across global markets. How mutual funds work. Pooling of resources. Investors buy shares in the mutual fund, pooling their money together. Investment by fund managers. Professional managers use this pool to invest in a diversified portfolio. Net asset value, NAV. The value of a mutual fund share, calculated daily based on the total value of the fund's portfolio. Dividends and capital gains. Investors earn returns through dividends, interest, and capital gains distributions. Benefits of investing in mutual funds. 1. Diversification. Reduces risk by spreading investments across various securities. 2. Professional management. Access to experienced fund managers who make informed investment decisions. 3. Liquidity. Mutual fund shares can be bought or sold on any business day. 4. Affordability. Allows investors to participate in a diversified portfolio with a relatively small amount of money. 5. Transparency and regulation. Regular updates and reports on fund performance. Regulated by financial authorities ensuring investor protection. Strategies for investing in mutual funds. 1. Goal-based investing. Align mutual fund choices with financial goals like retirement, education, or wealth accumulation. 2. Risk assessment. Choose funds based on your risk tolerance and investment horizon. 3. Asset allocation. Diversify across different asset classes to balance risk and return. 4. Systematic investment plan, SIP. Invest a fixed amount regularly to take advantage of rupee cost averaging. 5. Performance review. Regularly review fund performance and make adjustments as necessary. 6. Expense ratio. Consideration. Opt for funds with lower expense ratios to maximize returns. Risks associated with mutual funds. 1. Market risk. The value of investments can fluctuate with market conditions. 2. Interest rate risk. Affects debt funds. Bond prices inversely related to interest rates. 3. Credit risk. The risk that issuers of bonds may default on payments. 4. Liquidity risk. Difficulty in selling fund holdings without impacting the price. Exploring the lesser-known aspects of mutual funds can provide investors with a deeper understanding of this popular investment vehicle. Here are some intriguing and lesser-known facts about mutual funds. Mutual funds, while a staple in many investment portfolios, hold a wealth of nuances and lesser-known details that can significantly impact an investor's approach and strategy. One intriguing aspect is the sheer diversity within mutual funds, which goes beyond the standard categories of equity, debt, and balanced funds. For instance, there are funds specifically designed to cater to ethical investing, known as ESG, environmental, social, and governance funds, which focus on companies with sustainable and ethical practices. Another interesting facet is the concept of load and no-load funds. Load funds charge a commission or sales charge, which can be front-end, paid when buying, or back-end, paid when selling, while no-load funds do not charge any commission, potentially offering cost savings to investors. Additionally, mutual funds are required to distribute capital gains to investors, which can have tax implications, a factor often overlooked by many investors. This distribution occurs even if the investor hasn't sold any shares, potentially leading to a tax liability. Furthermore, the expense ratio of a mutual fund, which covers management fees and operational costs, can vary significantly and directly affect the net returns of the fund. Investors might also be surprised to learn about the turnover rate of a mutual fund, which indicates how frequently the assets within the fund are bought and sold. A high turnover rate can lead to higher transaction costs and tax implications, impacting overall returns. Another nuanced aspect is the role of mutual fund managers and their investment strategies, which can range from passive index tracking to active management aiming to outperform the market. The success of a mutual fund often hinges on the expertise and decisions of its managers, making their track record an important consideration for investors. Additionally, mutual funds offer a degree of liquidity, allowing investors to buy or sell shares on any business day. But this liquidity can sometimes be affected by market conditions or fund-specific restrictions. Lastly, while mutual funds are often seen as a safer investment option compared to individual stocks, they are not entirely risk-free. Market risk, interest rate risk, and credit risk are all factors that can affect the performance of mutual funds. Understanding these lesser-known aspects can empower investors to make more informed decisions, aligning their mutual fund investments with their financial goals and risk tolerance. When considering short-term investment options within mutual funds, it's important to focus on types that offer liquidity, lower risk, and potential for modest returns. Here's an in-depth look at the top mutual fund types suitable for short-term investments, delving into their characteristics, benefits, and considerations. Money market funds. Overview. Money market funds are among the safest mutual fund options for short-term investments. They invest in short-term, high-quality debt securities such as treasury bills, certificates of deposit, and commercial paper. These funds aim to provide investors with stability and liquidity, making them an attractive option for those looking to park their money for a short duration. Benefits. Low risk. Due to their investment in high-quality, short-term securities, money market funds carry minimal risk. Liquidity. These funds offer high liquidity, allowing investors to access their money quickly. Stable returns. While returns are modest, they are generally more stable compared to other mutual fund types. Considerations. Lower returns. The safety and liquidity come at the cost of lower potential returns.